how's it going, everybody? My name is Antonio. Don't worry, I'm still an aspiring grill master, though in a different setting. And I have an experienced grill master here with me today, so I'm not doing it alone. With that being Luke ten Haven, who I did a weekly podcast with him for I don't know what it was, maybe 3 quarters, like 8 or 9 months last year. But then
Yep.
he kind of got tired of looking at my face for a few hours each week. So can you really blame him? So we gave that a break, and now we're back. Some people say I might be blackmailing him with my knowledge about his padel skills. Others say that maybe my copper top is growing on him. I'll let you be the judge of that. But so what we're doing here is simply an overview of the junior market from the past week, with typically one or two other guests to basically discuss this from the perspective of private investors. So how are people? So Luke is basically, well, he's making his own money in the space. I'm trying to make my own money in the space. And how do we pay attention? What do we pay attention to? How do we look at the sector? Basically, we are going to be recording these on Fridays. We'll have them edited and with you on Mondays. Typically, that's at least the goal here, the plan. But this time we'll have a guest on as well, as I said, starting with Rick Rule this week. That's going to be a big one. He'll be joining us as well. And then potentially other people would too over time, as I said. But as always, before any of that, fair disclaimer and an honest confession, although Luke has been successful in his career so far, I unfortunately haven't. But even if I were, we both remain just two talking heads on the internet who should not be trusted blindly. I'll need you to understand that for everything we discuss in here, we are likely to make mistakes, likely to make forward-looking statements, and we are likely to be biased. This channel is a business whose clients are primarily issuers, and again, as I said, both Luke and I invest actively in the space, so we might be discussing some of our personal holdings from time to time. Although that's not the focus. Either way, please go to setterplus.ca or the respective authority website to read the company's official filings before consulting a licensed financial advisor and before taking your own decisions in the end, because our conversations will be general and impersonal in nature, so you will not be receiving any personal investment advice in here. And dear issuers, a message for you as well. If your feelings get hurt by anything we say in here, just email me at antonio@resourcetalks.com, and we will give you the opportunity to explain yourself on an interview here on air. We're not here to make anybody look bad. We're just discussing this wonderfully horrible space. That all said, Luke, gold and silver are both up this week, both around 3% in the green. And so actually pretty much all other commodities up besides palladium, platinum, and cobalt, which are down about 3%, something like that. So naturally, logically, highly anticipatedly, our junior lottery tickets should be up too. But unfortunately, that's not how the TSX and the TSXV work. Both of those indices are down some 4% or something like that. GDX, SALJ, GDXJ also flat, basically. So there's not much to be happy about, kind of boring stuff. What is interesting this week? What are you paying attention to?
Yeah, let me correct one thing. You referred to yourself as an unsuccessful investor, but I think you made one big investment, and one out of one, I think you made a pretty big score already. So with Awalé, so I think so far so good for you. And let's not talk about my padel skills, but yeah, no, true. It's the market is, well, I think the market's turned for juniors and for certainly for the metals. And happy to be back. There was a different reason to quit that for a couple of months, not the not
Not my
your
face.
face.
I'm not
So
buying that.
so let me also add a little bit to it that we I mean, the idea is indeed to talk about the weekly movers and other things from a private investor point of view. And we are not geologists or CEOs or anything, but we do try to make money in the business. And if anyone cares, then we will look at these things, and we're open for questions as well. So yeah, one thing I noticed this week is, and not only this week, but one of the stocks that went down this week is Kingfisher Metals. And the reason why I want to highlight that one is I think it's one of the real teams, like young teams. Everybody talks about we need young people in the business, we need real greenfields work, and they have done that. But they went public in 2021, and with a 26 million market cap, the market was still very strong, and they went out of the gates with 88% up on that one day, I think, at 80 cents. And 80 cents translate into $4 right now because they had to roll back. And that's why the stock is so weak recently. So from $4 to 15 cents. And around the same time, Kinoland also went public a bit earlier, and they came public with a discovery and some prospect generation business. And the reason I compare the two a little bit is because both of them are young teams. Both of them, I think, are well respected, a good board of directors, strong insiders, insider buying. They both attracted big investors as well. But still, Kingfisher went from $4 to 15 cents after the rollback this week, and Kinoland has been stable. And I don't think either of them is very happy because Kinoland made a big discovery, did a good deal for the royalty. They made prospect generation deals, a lot of partners, and they are only flat after a big discovery. And Kingfisher, which is also doing greenfields, didn't make a big discovery, and as a result, and a bad market, the stock is down maybe 90%. And it shows again that even with good people, even with insider buying, a lot of insider buying, they attracted investors who were really in the market with 30K and 80K and 50K. I mean, really big amounts of money going in on a weekly basis. Crescat was in the name, or is in the name perhaps. Amazing projects which are also promoted in a good way, not in bad ways, and still a stock can go down so much. So I think it highlights that even investing with the good people and the good investors is still high risk. And yeah, I brought a couple of images to compare those two, Kinoland. And one other learning I have from this is that prospect generators are often seen as boring, and any minority interest is seen as sort of boring, and why would you ever give it away? But in Kinoland's case, it at least sort of saved them from losing money, or saved investors from losing money. Awalé is an example that did well with a 30% interest, or maybe 25 in the end. Orion is an example who's doing quite well with a minority interest, at least part of the company. So I think it's not the only thing, owning the project outright. I think it's you need a bit of luck with a discovery, but it's also how are you gonna spend your money and how are you gonna raise your money? Because this company Kingfisher has been able to raise money, but still the end result is a $4 million market cap. And let me end it by saying that, I mean, now that the rollback is done, and we can talk about a rollback as well, is that a good thing? Is it a bad thing? But you can get the same projects, the same motivated team, the same investors. You can get everything for 4 million, and you paid 40 million for it just 3 years ago.
What's the difference though? I mean, in terms of risk, where you paid 40 million, but maybe the cost of capital was different. Obviously, didn't play out. And the rocks are still there. I spoke to Dustin as well. Great guy. I don't think there's two opinions about that.
Yep.
But what is the risk right now, given that the cost of capital is rather high going forward?
Yeah, it's true. But I think almost like I would guess that 90% of the juniors have a very high cost of capital right now hopefully at the bottom of the junior mining market. And that's the risk reward in this business. I think you want to pick them up very low, and of course that's very easy to say right now. In 2020 and 2021, everybody was just excited about the business, and it's a business like that where excitement can go in a year. And I was reading in preparation of this a little old tweets from several people, influential people and less influential people, and people are really agreeing with each other, of course, that it was an amazing opportunity at $26 million market cap. And there was 6 million in the bank, and the projects were amazing. There were 300 surface samples. All of them the average was 5 grams or something. You just have to realize that with any company, and this is not against Kingfisher, it's just showing that a good company with motivated people and good investors, you can still end up with something like this. And you always have to be careful, even in the Awalé case, where they may have the best drill hole in the last 3 or 4 years, that something can go wrong suddenly. And even though everything looks amazing today, a year from now, everything can be completely different. And I think Kingfisher is, a good example of it. It's not a good example. It's sad because it's real work, and a lot of companies don't do real work. This one does, and still you end up with this share price. I think it is an opportunity. I'm not trying to sell it. I have no bias because I don't own it, but I think it's an example of a company that can go down 90%, even though it almost checks all boxes 3 years ago.
Do you think it's still going to take a lot to move it here, like, or would a market suffice? I mean, if it's a good market, all boats rising, is that going to be it, or do you think it really takes a big discovery now?
Look at Awalé. I mean, nobody is interested, almost nobody, at 10 cents. And now people are willing to pay 60, 70, 80 cents in the market or in a financing. Yeah, of course, a discovery will solve a lot of problems, but discoveries do not happen very often. The prospect or the potential of a discovery could also do a lot. And if you want to be in a discovery early, like you did with Awalé, and you didn't know this was going to happen, but you have to, pay some of those lottery tickets, if you want to call them like that. And yeah, I mean, I think if you talking about you as an investor, Awalé was and is a very big position for you, and
Mm.
it's a risky thing. I mean, how not many people will be able to repeat that ever if you just own one, two, or three, or four companies to be in one very big discovery. There's certainly a bit of luck involved, and I mean, promotion is one thing. I'm not sure how Kingfisher will do that right now, but they have a good project and a good team. Only that on its own is already a level of promotion. Um, I mean, people is probably the most important thing if you start to speculate for discoveries. So yeah, if you're at a 4 million valuation, you could easily argue that in a better market, something like that could be worth 10 or 15 million without, any news other than just a market improving. That would be a bet on the market, not so much on Kingfisher. But if you believe in the team and they will find new things, and perhaps on the current project, yeah, uh, then you could invest in such a story, or perhaps a number of those, Kinorland, Kingfisher, and other credible explorers.
Right. I think this is also a testament of how much the rocks matter, how much the potential for a big discovery here matters. I had no idea Wale would drill 1,500 gram meter hole, right?
Hmm.
I did, however, have a suspicion that this is a very big system. I spent a lot of time talking to geos, not a geo myself, but just reading up on things, reading older papers, doing geological comparisons and whatnot, trying to understand the project. Definitely luck involved. But in my opinion, this is just another testament of bottom-up investing, where, again, the rocks matter. But then also, currently what's happening with Awalé, what's happened this week with Awalé is another testament that it's not only the rocks that matter. You can have a literal 1,500 gram meter discovery, and you can still wet the bed on a financing that's happened here. And I think there's going to be an interview coming with Awalé CEO for sure. I'm hoping for some other people out of there, and the hard questions are going to have to be answered here, irrespective of me being a shareholder. Awalé is also a paying client of this. They advertise on this channel. That's not going to change anything. All these questions are going to have to be asked. There was insider selling that was not expected by anybody, and also just not in a million years that any of us expected a bought deal, massive discount, and a half warrant. There are a couple of things going on beneath the surface that I think if people do enough research and look at, for example, the holdings that the board is currently left with, and see who's holding shares and who's not holding shares. And you can go on LinkedIn and look at the different profiles of the different board members. There's a lot of things that you can figure out for yourself there. But the point is, there's going to be an interview on Awalé going there, and either way, I'm not. Nobody's happy. I don't think anybody's happy with how this financing was done. And this is just another testament that it's really a combination of all these things with luck on top, right? Because Kingfisher, great example of everything went right. They didn't have Awalé's rocks. Awalé has amazing rocks, but then there's still a few things that are causing trouble. And I say trouble, the stock is not down. I'm still pissed off at the financing though. So I'm kind of running in circles, I believe, right now. And I don't necessarily have a question here, but I know you have an opinion.
Yeah, well said. Yeah, and Kingfisher's rock may be as prospective. I mean, sometimes it takes a long time, but let's start by saying that Awalé would look very stupid if a month or two from now the stock is at 20 cents and it didn't raise money at this point. So raising money here and also substantial money, I think, is prudent to start with. Could they have done it without a warrant? I think so. I think if they announced the deal in the first couple of days or the first week, where they would just announce a non-broker deal for $5 million, I think they would have gotten it plus some extra. I don't know why it took so long. Maybe they have been looking for other opportunities, and maybe they didn't pan out. That's just speculation on my end. And there's nothing behind that. But yeah, I was also surprised by seeing that insider selling, waiting for a week or maybe even longer than a week for reporting is. That was even crossing the line, I guess. And then announcing a bought deal, and bought deals are probably, in my opinion, the worst way to raise money after a discovery like this, because you will not control who owns the stock. And in a broker deal or a non-broker deal, you can choose your investors, and that's typically better because those people are normally longer-term investors and more loyal. But bought deals can also be done with lead orders and with people investing for the long run. So it doesn't mean necessarily that it's a bad deal. There's likely people who will just buy it for the warrant and who will hedge their bets, and but it's not guaranteed that all the stock is going to small investors who have no clue. So so I think it's a bad, it has a really bad look. I'm surprised how well the stock is still trading. I was expecting it to go into the 50 cents, maybe even 40 cents. So I'm really surprised that it's doing so well. So probably
Why do you
because
think that is?
discovery.
What's your? I'm sorry for interrupting here. Why
Mm,
do you think that is? I had sort of my own thoughts about it, but
mm.
again, what do I know? Why do you think the stock's not dropping? I expected it to drop too.
Well, there's another level, and maybe this is a little bit of a step too far, but this is what I thought when I saw it. Awalé has announced that they were drilling on April 4th. Um, the insider selling was probably a couple of days, like a week later, reported another 2 weeks later, and suddenly this bought deal comes up, which looks a little bit desperate, in my opinion. I was expecting also, like you, a way better financing than a bought deal at a discount plus a warrant. And I was thinking, I mean, it smells a little bit if you see people selling and then announce a deal that doesn't look pretty. So if you then monitor a little bit what people think, and you look on Twitter, you look on CEO.ca, you talk to people, everybody is sort of like, why is this happening? And if there's panic, and maybe panic is the big word, typically you see a sell spike. So I was expecting it to sell off at least in the first minutes, because people were panicking, and people who own it then also panic, and you get this effect of people all starting to sell, which could have caused a opportunity. And it didn't really happen. It was a bit of selling, but not that much, and then suddenly it became a pretty strong market again. And of course, the discovery hole is super impressive, but I do think that the complete market valuation is currently carried by one hole, and that doesn't mean that BBM and all the other projects are not amazing, and the 100% ground is very prospective. But without this drill hole, it would never have gotten so far, because the complete project valuation right now is probably, well, 4 times the market cap, so above 200 million. And that's all carried by one hole, in my opinion. So if that next hole fails, then in my opinion, this market cap cannot be sustained in the short term. And that's why I thought, well, if people start panicking, then suddenly the complete thing changes, and you go from a positive sentiment to a very negative one. And that didn't happen. So I was wrong in expecting that.
Right, but why do you think that is? I mean, clearly there was some buying. It was close 15% up on the day of announcing that kind of a financing. But you look online and everybody's angry.
Mm.
Again, I didn't meet anybody who's happy with this raise, and this someone is. I mean, someone out there is buying. Someone is happy to buy at this price. Why? Like, what's pushing this?
Well, there's always, I can imagine that there's people who want to own part of this project. It's just it's Awalé only owns a portion of it, so you cannot there's no way to get your hands on the full project because Newmont has the 70% or 75 in the future. But big discoveries always attract a lot of interest, and I did see, the super excitement phase again in the days after the discovery. People couldn't just imagine how amazing this drill hole was. It's also very consistent. And look at all the major discoveries in the past. They all sort of moonshot if it's, if the upside suddenly becomes almost unlimited. And but I kept in mind, like, even in the best case scenario, let's just call best case scenario a Rupert Ickery type discovery, or maybe a newfound gold, or anything that trades towards 1 billion, then this project, if that's the maximum just for the moment, because I think thinking further than $1 billion is crazy for sure. So that would cap this at 250 million. There's still dilution to happen in the coming years. I think the project is completely carried by this hole right now, not by the 100% ground. So let's just say $1 billion would be already off the charts valuation. So 250 million project valuation is sort of the upside, sort of the maximum in my mind that you can reach. And it already traded at 110, 120 if you include all the warrants and the options and the financing. So there was only a double to be made if you believe this is worth $1 billion. But still, your question, why are people buying it? Well, amazing discovery. And if they can continue to make holes like that or release holes like that, then yeah, it is probably the discovery of the year. But that's the big question, of course. Can they repeat this and step out and hit it again? And yeah, in my opinion, it all depends short term on that or on BBM delivering something that is also an amazing discovery, because the 100% ground is not worth 200 million yet until they find something of significance there.
I think I value it differently, from a different perspective, where I think if the 100% lands were in the hands of a standalone company, they would be worth something. So take that off the market cap, or whatever you think it's worth. It could be a $5 million exploration company, or it could be by the end of the year, because as far as I understand it, based on my previous interviews with Andrew, he wants to have drill targets ready by Q4. This money allows him to have that. So I suppose you could, we tried looking very hard for a silver lining, that would be the silver lining here, right? 10 million bucks is a lot of money. It's going to get him through getting the drill targets, putting the first holes into the 100% land, and that's already going to start kicking out some sort of evaluation where, I mean, I don't think it would be half the market cap right now, but then they're worth something, right? And then the other showings, I mean, you call them projects, so BBM, Scepter, they're not. Lando now is a target that we hopefully hear something on soon. They're not other projects. What the assumption is here, as far as I understand the geology, again, based on what Andrew's told me, is that those are just different showings of one and the same system. And again, there is value to them, given how large this whole thing is, where mineralization is showing up in this box of what is 33 kilometers by 12 or 13 kilometers, something huge anyways. So there's that. Yeah, there's dilution eventually, I suppose, but I'd be even more surprised than I was at this bot deal if there was any dilution like next year or something like that. Obviously, if they drill 15 more type of charger holes, big ifs, of course, but if they did and the stock goes up a lot, then maybe they need to, hopefully, to do it more masterfully than this one, to put it mildly. But in any case, maybe that's a silver lining. Maybe someone's looking at that. I don't know.
I don't believe in a sort of very effective sum of parts valuation. When a discovery is made like this, I think people will give it extra credit because you have 100% ground. So there's a level of, you will get some valuation for that. But I think the market looks for a valuation that keeps it in balance. And you see the stock spike to $1.10. Obviously that was too much too quickly. So then it falls back to 80 cents, 70, 75. And that's where it sort of stabilized a little bit. So that's the level where, the market's willing to pay 75 to 80 cents, at least for the last couple of weeks. And without that drill hole, I think when you take that drill hole away, I mean, you will only have a very prospective company, and there are many of those. That's why I'm saying, like, you want to see a little bit more than one drill hole until you can start. I mean, I mentioned the number 1 billion, and that's of course a crazy number to mention after one drill hole. It took Rupert, 24,000 meter of drilling before they could really, after the discovery, before they could get $1 billion valuation and newfound gold, something like that, or probably more meters. But you do not typically get to $1 billion valuation for the project after 1 or 2 or 3 holes. And there's 1 hole into this discovery right now, and it already has, 100 something million, 200 something million valuation if you multiply it by 4. So
Yeah.
I mean, everybody has his own way of sort of valuing it, but the market said the last couple of weeks 80 cents is what it's worth right now, and I think it's fair. It's not cheap. It's not cheap. Let's keep it like this. It's not expensive. It could be very expensive if this cannot be repeated, but if it can be repeated, then it's maybe an opportunity for sure.
And I wonder if this really one hole that's carrying this, because the stock went to 40 something cents on the previous news release, which was BBM, which was 180 gram meters, 75 meter, very wide intercept of like 2.4 grams, I believe. And importantly, just the same fingerprint, the same alteration, the same geochem responding to the same type of geophysical analysis as well, which makes it even more interesting. And so that's why I'm thinking, is this a one hole thing? Or is it like, is the market starting to realize that this is sort of a combination of multiple things showing within that big box? Again, to be determined, we can talk about the rocks. And I'm not a geologist, you're not a geologist. There's at least one geologist listening to this and making fun of us right now. So there's not much that we could say this, but that's kind of how I look at this.
Yep.
But fine. I mean, I hope we get Awalé on. Maybe we get Andrew or whoever else from Awalé on this show, whatever it might be in a couple of weeks' time, and we can question them because they should be questioned. I mean, this goes back to, Canadian junior market raises that are not. I mean, that are not done in an ideal manner, to put it again mildly. So they should be questioned, and I hope we can do this maybe together in a couple of weeks.
Yep, sure.
What else is happening? You wanted to talk about McEwen mining, just doing a thing again. What's happening there?
Yeah. We talked a little bit longer about than I had expected about Awalé. So let's keep the 2 stories that we had in mind a bit shorter. So McEwen Mining is buying Timberline, it is, right? And I think it's, I mean, I don't have too much to say about it, to be honest, other than it's another sign that, M&A is picking up. It's not the first one. Recently, Alamos picked up Argonaut. It's a very different deal, of course, but there's a bit of synergy, I think, in Nevada, but there's not like an adjacent project here. So it was just noteworthy to have a look at it. Well, that there's a 110%, 120% premium by McEwen. But there's nothing that I could really find other than McEwen just recognizing an opportunity and Timberline recognizing the opportunity to sell out and give an event to shareholders. So that's, I would leave it there for the moment on that deal.
I've got nothing to see on there either. Only that McEwen has almost doubled since the beginning of the year, which is it's interesting to see. It seems like confidence in Rob is coming back to the market here. So I'm happy to see
Gold
that.
is also doing quite well. So some of these miners who did really poorly last couple of years and nobody had a good word for them anymore suddenly start moving again. So all small signs that the market is improving again and people are willing to bet again on these people and good names like Rob. I was a bit surprised that everybody was so skeptical about McEwen Mining. I mean, probably for good reasons, because the stock didn't do well and the company didn't do well. But I think it likely will improve again now that the market is improving, and I think Rob will in the end succeed again.
Yeah, well, good to see M&A coming back. I suppose I don't know if that's necessarily the starting what do you call it, the starting gong or something like that of the M&A market. I think this might be just. I mean, what do you think? Is this just happening in isolation, or is this really more of a market timed move?
Quite difficult to say. I think every M&A transaction you see that is mean, one transaction is you cannot conclude anything from that. The Argonaut M&A deal recently was a likely one. I was expecting it to be earlier because that's a very interesting project next to Island Gold. This one, I mean, I would see it right now as an individual one, but Osino, you see, so M&A. I mean, M&A is picking up again, and projects are cheap. Some companies are pretty burned out. I mean, they had to raise money, or they didn't raise money. They couldn't. The market is turning. So often, in hindsight, smart money is or was buying in a market like this. And a year from now or 2 years from now, these people can tell everyone how smart it was to pick up these projects. It's very difficult. If you look at how difficult it was to raise last year for companies, even with good projects, you know, you have to make a decision as a company. And at some point, some boards will decide to sell, and maybe at the wrong point in hindsight, but we'll find out if that's true in a couple of months from now.
Yeah, for sure. That Argonaut deal, I wish we were doing the show back then when it happened, because there was a bunch of people pissed off, rightfully so. Again, I think I did an interview with them a couple of months before that. So, anyways, lots to talk about there too. We do have to get moving so that we're not late for our chat with Mr. Rickroll there, which I suppose is going to be quite fun as well. But it's the last thing that we wanted to talk about is that you basically said, like, Antonio, I want to showcase something on the show, and I was like, okay. And you send me this company. I had a look at it. It's sort of I have a smell test basically. And trust me, gingers have great senses, smelling senses, not so much sense of humor. But I just looked at the company's financial statements, and then just before this recording, so I looked at the Cetera financial statements called Showcase Minerals Inc., this company. And unfortunately, not to my surprise, they're indeed putting in a strong effort to showcase the business. That's the only thing they can do as far as I could tell by their financials. But they're spending 120 grand per month on marketing, or at least they did over the first 3 months of this year, which is in and of itself, that's not a low spend for a sub $20 million market cap company. That would be, if this was their entire G&A spend, it'd still be relatively, it wouldn't be exorbitant, but it'd still be relatively high. But it's definitely not a low spend, even when you compare it to the average exploration and evaluation expenses, and that'd be $20,000 for the entire quarter. So less than $7,000 a month on advancing the projects. And I didn't even look at the footnotes to see what they're spending it on, because it really doesn't matter. It's definitely not drilling, so probably just kind of walking the bush. So that's versus almost $120,000 on talking about the project. And then second smell test, maybe lick test, what you want to call it. But it was the SEDI filing. It's full of redness, basically. That's where you see the insider trades. And that's when I kind of gave it up. I was like, okay, I don't even know why we're going to be talking about this, but you clearly haven't given up. So why are we looking into this?
Well, the TSXV is a very interesting market, I think, and I always look at at share structures because I find them very important. And this one only has 20 million shares out. Went public early 2023 and in January. And it was $400 of trading that month. $400, not 400,000. And in February, $700. And in March, $40,000. And in April, 8,000. I will not continue until today, but it was 10,000 per month, more or less. And suddenly in September or October, you see it pick up like 200,000, 400,000, and then suddenly $6 million in February this year, and then $14 million in March, and then $13 million in April. The stock really, I mean, went from 30 cents or 40 cents to $4.50, and then I became interested. So what pushed this company from this tiny stock to a almost $100 million company? Well, the following: they started exploration on the ground. They did a $400,000 financing with 5 investors, one in Taiwan. They outlined 2 targets, added a director, provided a plan for a 12-hole drill program, and that was it. So and the drilling will start next week, I think. There was nobody who talked about this company in 2023, so nobody knew about it on CEO.ca, on Twitter, or any social media site. I didn't see, some people talked about a German promote. I didn't see any German promote. So if you look at the prospectus, the initial financing was at 2 cents. Warrants Series A, and then there was a Series B of 10 cents about 2 or 3 years ago. So those shares are probably tradable, and that's probably where liquidity comes from. But what I couldn't figure out is who was buying. So there was a marketing agreement of $500,000 US, so way more indeed than the drilling program so far. And could that have caused it? I looked at some videos. They were quite funny because they compared it to Barrick and Newmont's projects in Nevada, and they had some similar geology they talked about. And of course, we are making a little bit of fun, but it's fascinating how companies like this can go from a couple of $100,000 market cap when they were private to 100 million in a year time. And now the listeners are probably thinking like, okay, now we get the answer. Why did it go up? I couldn't find it out. It's there was certainly a lot of buying, and I couldn't trace it. I just found it a fascinating another story, and I will keep an eye on it to find out if other people know where this buying came from. Sometimes you cannot really find out, and perhaps we or I are overlooking something, and something is amazing about it. But I couldn't find much more than just a couple of early stage exploration programs without much news about it, and an upcoming drill program leading to this massive volume. The stock was halted a couple of times, and that's it. That's all I could find about this company. So maybe this is a to be followed up one when we find out more about it. But I wanted to share it because we talked about Kingfisher, a real company doing real work, and having a hard time getting investor interest. And this company, where I didn't really see a lot of drilling yet or any promising signs going up 10x or maybe 100x for the initial buyers, without many reasons I could identify. So
I
that's
was
there you
looking
have it.
at I was looking to see what kind of promote this might be. It's funny you mentioned a German promote because when I put in Showcase Minerals into YouTube, there's a suggestion coming up that it uses the German word for stock. So Showcase Minerals stock, but then it's only in German. Um, so maybe there was something about this. And I guess a more practical takeaway here is, and as I said at the beginning, if Showcase Minerals management happens to be listening, very welcome to come in for an interview. We'll give them a fair ride. And they won't even have to pay us. So why not? But at the same time, what I'm thinking is what more actionable, what would be for people more actionable here is like if you hear about a stock somewhere, buying it just off hearing it once is just a crazy amount of risk. This space is risky as it is. I think that we've highlighted it here with Awalé, with Kingfisher, with everything so far. Even McEwen Mining, if you look at again, as you said, how that's been performing over the last couple of years. There's just a lot of risk even in the real companies here, and a lot of stuff happen. So if you hear about a company from someone, just do more work, just do more research. There's setter filings that you can easily pull up at setterplus.ca, as I said, it's the official Canadian website. Uh, Look at interviews. I mean, the Showcase Minerals doesn't have any. There's no interviews. There's only people talking about it, as far as I could tell. Or maybe there's no, that's not an interview either. Oh yeah, just look at interviews, see how the CEO behaves, and so on and so forth. Try to reach out to the company and ask them some of these questions. Then I think Rick Roll has a couple of those questions himself that he asks companies. It's not hard to do all these things. Just don't blindly buy something based on the first time you hear about it. I think that's pretty much the only way to protect yourself. And like, because I wrote down, how do I not become the victim of something like that? And I think that's how I would do. What would you do?
Well, sometimes you could jump on the train if something like this, showcase is happening. But you have to be. I mean, the more work you do and the more years you spend in this business, you start to recognize things. And I mean, if you like trading or speculating on, on things like this, you could even make money on it, I think, for a while. But yeah, if you want to, I mean, Rick Rule, for example, I think he likes prospect generators. He probably even was the person, I'm not sure if he coined that word, but he was certainly investing in prospect generators in the 90s and early 2000s. And if you invest in a number of them and you give them the time and there's a clear goal, a number of questions that company needs to answer, as he often refers to, that's also a way to do it, and a much more reasonable way to invest, I think. But sometimes a promote could even do better. So the showcase is, as far as I can see, very well promoted. Let's put it like this. And for some people, that could even be the flavor of the day, if you like to play those things.
If you like going to the casino. And you just missed a chance to say that it was very well showcased. You got to up your game for the next interview, Luke. But
I
this has
think
been,
you already made that joke, and
you can
I
make it
think
7 times.
showcase.
It's so funny.
And I think this could have been a ChatGPT name. I think if you ask for a promotional name, I think showcase is a word that I see ChatGPT generate quite often. So maybe it even came from ChatGPT.
Oh yeah, that's I guess that's one way to name a company. I'd make a showcase joke here, but you didn't like the first one, so I won't. And it'd be fun to get showcase management on for an interview. Yeah, I mean, I totally do. If anyone is listening who knows management here, or if I don't know if management's listening or whatever, again, we don't want to be mean to you or whatever, reach out to me and Antonio at resourcetalks.com, or if someone's listening, management, make me do an intro at Antonio at resourcetalks.com and management. We'll set up an interview free, all fair questions. We don't send the questions up front. No editing rights as always, but still, we'd give them a fair ride. And also, if there are people with any questions, by the way, that you'd like Luke and I to go, well, mostly Luke, to go over during future episodes, just post them in the comments. We might be doing sort of a Q&A session in the future as well. And yeah, Luke, I think that's about it. Let's maybe let Rick roll in, because we're kind of ambushing him here because he doesn't know it's going to be the two of us. I think he only thinks he's talking to me. Luckily for him, though, he's not mostly going to be looking at my face. But let's actually start with you, Luke, because you told me that you'd like to ask Rick something that he's not been asked before, and I've seen at least 143 interviews with Rick over the last 2 weeks. So I guess take it away. I'm curious.
Yeah, hi Rick. Nice to finally talk again. We talked only once 10 years ago, and it was about Stratex, a British project generator. But now 10 years later, the second talk, and my first question is really about. Well, I have to introduce it a little bit. Yesterday or a couple of days ago, I think, you posted a video about the art of private placements, and you said to the audience there, "Write this down: no warrants, no money." And you gave the audience a couple of arguments why, and one of them was management teams find warrants to be dilutive, and it's interesting that management teams don't find options which they get to be dilutive. And I think that's a very fair point. There were more arguments, but this one, let me contrast it a little bit with my opinion and see how you respond to that one. What I always notice is that, or often notice, is that companies that have a lot of warrants out, most people who own those warrants do not have to report the selling or the buying that they will do of it. And as a result, the company like Hercules Silver, who made a big discovery last year, or potentially a big discovery last year, they only doubled after $33 million of market volume. And you almost never see 33 million of market volume in junior mining stocks. So the real question becomes, Hercules, we all there with the 50 million warrants they had at the time, would they have ever made it above the warrant price if they didn't make such a big potential discovery, but perhaps they only made a smaller silver discovery, the one that they were earlier on targeting?
You need to ask a question before that, Luke, which is to say, without the inclusion of the warrant, would they ever have been able to raise the money? The answer to that, when they were chasing a scrappy little silver vein in Idaho, is no. The warrant itself was the inducement that allowed them to raise the money to drill the hole. The argument after that becomes, in effect, moot. I think the structure of a warrant, who got it and who the investor is an important consideration. For me, as a check writer, before I care too much about entering in to the discussion of the structure of the placement and who the placees are, I just want to know I'm being fairly compensated for the risk. In the case of Hercules, and let's use that as an educational tool, you had a company where there was a fairly large amount of stock issued pre-public at rounds that were substantially below in terms of price the save the company round that had to, by necessity, include a warrant, or else the money wouldn't have gotten raised and the company would have perished. And when people look at warrants and describe them as being dilutive, or they look at warrants and they look at them as being a cap on the share price, they need to consider where the real dilution took place. The real dilution took place before the subsequent capitalization came in, which is to say the 6-cent round that included the warrant had already been diluted by a 1-cent round that occurred before it. Without the warrant, it is highly unlikely that people would have been induced to invest at 6 cents in a scrappy little silver vein, given the amount of stock that had already been issued before that. You understand where I'm going with this?
Sure, which makes it more difficult for the on-market buyer, I think, to invest in those type of deals, because you know that there's sort of a cap on top of you that will unlikely be breached unless a big event like this, which almost never happens.
Well, you know, in the early days, in the formation of companies like Silver Standard, Pan American Silver, Bema Gold, First Quantum, we issued a lot of warrants. We issued warrants to a fairly intelligent group of investors, and the prices that we raised the equity on took into account the valuation of the warrant. In other words, the inclusion of the warrant raised the price of the unit that we were willing to pay. It might be that without a unit in those days, which, by the way, the late 90s were much bleaker in terms of capital raise than today. People have a bad memory with regards to that. In those days, an on-market financing that didn't include a warrant in a company with less than sort of $30 or $40 million in market capitalization would have required, at a minimum, a 20% discount to market. On top of that, the dealers, the Canacords, the Haywoods, and yes, even myself, would have included a private placement commission that was somewhere between 5% and 10% of capital raised, plus allocable expense, plus broker warrants, which is to say that the total cost of capital without the inducement of the warrant would have reflected 35 or 37% of immediate dilution. With the inclusion of the warrant, some brokers, at least myself, threw out the inducement of the broker warrant and reduced the cash commission from an average of 7% down to an average of 3.5%. And by the way, at least me, I always took the 3.5% commission in units, not in cash. So when people talk about the fact that warrants are dilutive, if you look at in the context of the examples that we just gave, the warrants, the existence of the warrants caused the units to be priced at a 5% rather than 25% discount. They caused the cash and non-cash compensation to the dealer to reduce from circa 10% to 3.5%. In that circumstance, the warrant is anti-dilutive. Secondly, to the extent that the warrant is a well-structured warrant, which is to say that there is a fuse on the warrant, that's important. Let's say that we are doing a deal on a stock that's priced at $1. And let's just say, for argument's sake, that the warrant is priced at a 50% premium. So the warrant is exercisable at $1.50. I would always concede to a management team that asked for it, and sometimes even suggest to them that if the stock traded at, say, $2, for 10 consecutive trading days, that the warrant holder would have another 10 days to either use or lose the warrant. That was important for two reasons. If you had had enough exploration success based on the money that was initially contributed, that the stock had escalated a lot, the company was very likely to need to put more cash in the treasury. And the warrant gave them the ability to do that on already agreed upon terms with no commission.
And that's something that's happening right now with Chakana Copper, I guess, which they
exactly. And that was a deal with regards to the warrant and the fuse that I structured. The other thing is it's important that the warrant have a fuse on it, because there are a group of people who use private placements and warrants to hedge by way of shorting the stock, thinking that ultimately they'll be able to cover with regards to the warrant. If the warrant has a fuse, it becomes a much less effective hedging instrument for the shorts. So I think it's important to understand the intelligent structuring of, in particular, exploration finance with regards to warrants. The suggestion that they're dilutive, particularly by management teams that have awarded themselves 25 or 30% of the company at prices between 1/10 of a penny and a penny, describing a warrant as dilutive is pretty disingenuous. The dilution took place long before the initial public offering. If we're going to do the arithmetic, let's do the arithmetic concerning both the numerator and the denominator. Secondly, the inclusion of a warrant, intelligently done, reduces the cost of capital by reducing the discount to market and reducing the cash commission to the dealer. So in that regard, it's anti-dilutive. And in the third instance, to recap, an intelligently structured warrant gives the issuer access to capital on a successful efforts basis with no time delay and no further cash fee.
It's kind of confusing
go ahead.
for me from the perspective of and I want to understand how you deal with that, Rick, from the perspective of, if I participate in a private placement, obviously I want to have a warrant. It's a free warrant, right? But then when the company raises money again next time, ideally I would prefer them to raise money without a warrant if I'm no longer participating in that private placement. Because unless you're willing to keep putting in capital, that's more dilutive to you. Is that not the case?
Not necessarily more dilutive to you. It's there it becomes a function of tax. I have decided when I'm participating in a speculative company, it's not completely true, but I believe it to be true, that I'm the only source of capital that I can count on an ongoing basis. So as an example, if you look back to our participation in the companies that I mentioned before, the BIMAs, the First Quantums, the whole range of Lundin companies, Silver Standard, Pan American, I always understood that on successful effort, I would be participating in a series of financings. And when the stocks were really, truly gapping up, when there was all kinds of volume, I made sure I sold enough and that my clients sold enough that we would be able to participate in a subsequent financing if the warrant exercise wasn't sufficient to fund rational growth by way of the company. Issuers in those days, the Lundins, the Friedlands, the Beatties, the Clive Johnsons, liked us because they regarded us as a rational and continuous source of capital.
Will they become more dependent on the same source then? Because if they do not give you the answer you're looking for, the exploration answer they're looking for, then the story may not really take off. Maybe there's some good news, but not good enough to really get it above a certain warrant level. And they are forced to almost go back to you and ask you for a new financing, while maybe without the warrant, the medium news, like not the amazing news, but the good news would have pushed it over that level.
I certainly agree with you that for the marginal issuer or the junk issuer, where the reality will never overcome the narrative, that they shouldn't issue warrants. If you're a trader, if what you're trying to do with your portfolio is participate in stocks where you're jitneying a 25-cent stock out at 40 cents. You don't want warrants. That isn't what I do. I frankly have zero interest in a trade. I have an interest in participating as a speculator on an ongoing basis in material success. The consequence of that for me is that most of my speculative investment decisions, like everybody else, frankly, turn out to be mistakes. But my winners have to amortize my losers. I have to have the occasional 10-bagger that can make up for a series of 20 or 25% losses. And from my point of view, the best way to do that is with a warrant. Because with a warrant, a 10-bagger becomes a 15-bagger or a 17-bagger. I absolutely agree with you that for the length and breadth of the Canadian junior issuer community, which is flotsam or jetsam, the warrants are suicidal, as they should be, because these things aren't actually financing vehicles. They're trading vehicles. They're trading sardines. And from the point of view of a trader, in what is in effect a greater fool exercise, where you're trying to find a subsequent speculator who is even dumber than you are, warrants are problematic because they put a cap on the upside of a narrative. I hope that helps.
Yeah,
A fairly harsh answer, but I guess it depends on the quality of the issuer and whether your definition of dilution is narrative or arithmetic.
Well, in my case, it's very hard to find someone who's dumber than me, so I try not to go and do that. But what about when there's a really good discovery? There's a recent discovery that looks to be a very good. Well, we talked about this off mic a little bit too. Awalé Resources had a spectacular hole. How would you deal with something like that when it comes down to warrants? Like, will you ever be like, okay, I don't need warrants. This is too good to think about anything else. I just go in.
Yeah, absolutely. To the extent that you have an opportunity, listen, money's made on the delta between price and value. So if you have a discovery and the market hasn't reacted to that discovery, which is to say you're able to buy reality at a discount, then you don't need a market. Then you don't need a warrant. But in the exploration business, you seldom have that opportunity. In the exploration business, you are usually answering unanswered questions. The warrant then, in the case of the discovery that you're talking about, will depend on the management's ability to tell the story to sophisticated investors who don't need or want a warrant. I know some very large institutional investors who are so lazy that they don't want to do portfolio accounting that involves warrants. In other words, they don't want a warrant because they don't want to do the bookkeeping. Now, to me, this is felony stupid. I mean, this borders on poor fiduciary stewardship. If the bookkeeping interferes with your quest for performance for your client. But that notwithstanding, I know a couple very large institutions who prefer not to get warrants because they don't want to do the bookkeeping. Believe me, I'm happy to do the bookkeeping.
If you jump back to you already mentioned the 90s, and there were some really big discoveries, and I believe you participated in a number of them. And you look at the share structures at the time, like Diamet with Ekadi 9 million shares out, Diavik 15 million shares, Diamond Fields 16 million, Arequipa 28, Francisco Gold 9 million shares out. Was that more a function of discoveries didn't take very long because they were easier to make, and hence they were made early in the process? The dilution didn't really get that far, or was it simply a capital structure difference, and over time that changed in the market?
Some of both. In the mid-late 90s, those few investors who were left in the space were fairly sophisticated. And we didn't care very much about how many shares were outstanding. We cared much more about the market cap. So if there were 100 million shares outstanding at 2 cents, I remember famously Warren Buffett said that people who cared about share counts were mostly stockbrokers. He likened it to going into a pizza parlor. He says a stockbroker goes into a pizza parlor and he orders an 18-inch pizza. Sorry, I can't make it metric for you. And the young man behind the counter says, would you like that 4 slices or 8? He says, oh, you better make it 4. I could never eat 8. The point being that it's the shares times the price per share, which is to say that the market cap, that's important. What the promotional community figured out is that most investors aren't that sophisticated. They think a 5-cent stock is cheaper than a 50-cent stock without paying particular attention to the number of shares. In other words, without paying attention to the market cap. It is easier to hoodwink investors around nickel stock than it is to hoodwink investors around dollar stock. The jobbers, which is to say the market makers, particularly in AIM and Australia, like very low market caps because if they're making a bid and ask spread, their spread between 5 cents and 6 cents is much bigger than the spread might be between 50 cents and 52 cents. So there's an institutional bias for larger floats of lower priced stock. That, by the way, is beginning to change. And I think that you'll see it change a lot over the next 5 years. Companies that are successful, that have the ability to introduce themselves to the U.S. retail equities markets with a U.S. listing, and then avail themselves of an at-the-market financing mechanism through the New York Stock Exchange, enjoy the lowest cost of capital of juniors in the world. And that generally requires a $2 share price. So what I think you're going to see among those few successful penny dreadfuls in Canada will be reverse splits so that they can list themselves in the US and avail themselves of at-the-market financings without having to subject themselves to the bottleneck of the Canadian dealer network. It's a much more efficient and much lower cost equity capital mechanism. And I think that you will see the gradual change with successful companies from massive low-priced share floats to much more controlled share floats, much lower spreads between the bid and the ask. You follow where I'm going with this. You won't see it among the junk. The flotsam and the jetsam, amalgamated moose pasture, consolidated orangutan, that normal sort of BS Canadian junior, will always want to be a 5-cent stock or a 15-cent stock or a 20-cent stock because it's easier to hoodwink morons with larger floats and lower share prices.
Could that also become a little bit too much of a target? Because I remember Rob McEwen, and he is very sophisticated in the business, talk a lot about that $2 share price and him wanting to go to those exchanges for that reason.
You have to increasingly. If you're Rob McEwen, if you're a real player, you need to get the trading volume out of Canada. Canada is a great place to start companies. There's a sophisticated regulatory regime. There's a sophisticated financial services regime. There's a crew of sophisticated investors, both retail and institutional. But in the North American context, Canada is less than 7% of the savings and investment climate ecosystem in North America. And Canada is overserved in terms of natural resources. The United States is 93 or 94%, and it's underserved. It's simple arithmetic that once you get to the point where you are above the penny dreadful status, once you've become a sensible as opposed to a nonsensical speculation, you move your trading volume south of the border. In addition to capturing greater liquidity from a greater investor pool, you access in the U.S., provided you are at sort of 200 or 250 million market cap, the ability to do at-the-market financings. install an evergreen prospectus so that you can issue new shares into the market rather than through a marketed effort. This is at once more efficient, but it's also much, much cheaper.
What I've been thinking about mostly around the increasing number of shares outstanding comes from a chart that I recently saw that it was tweeted by Garrett Gogging, showing the gold price to the shares outstanding of the 4 largest gold miner from 1994, which funnily was before I was born, to the gold price. And so the gold price went up 5 times since then, but the number of shares outstanding went up by 9 times. And so people sit around and wondering, why am I not making money when the gold price is going up? And I think that's a fair answer to say like that this is where you're not making money. There's a lot of supply of those shares and not as much demand.
Well, there's a reason that's deeper than that, Antonio. If you take us back to the decade 2000 to 2010, actually give me a year, 2000 to 2011, so an 11-year time frame. The gold price went, if my memory serves me correctly, from something like $256 an ounce to $1,900 an ounce. A more than 7-fold increase in the gold price. Free cash flow per share on the XAU fell. It took remarkable skill for the mining industry to turn a 7-fold increase in the selling price of their product into declining free cash flow per share. The reason I would suggest that the gold mining industry is held in such low regard today has been the extraordinary efficiency with which which managers of the gold mining industry destroyed cash in the last 2 decades. They issued the new shares because they had to raise money. Yes, the selling price of our product has increased 7-fold. As a consequence of that, you should invest in us, and we need you to because we lost all the money you sent us before the gold price increased. It's important that investors who listen to your podcast understand that if you invest in the sector, the gold mining industry, you are guaranteed over time to lose money. If you invest in individual companies in the sector, if you pay attention to real good-fashioned old securities analysis, and you confine yourself to a small subset of companies that are performers, this subset of performers has generated such good results that they've added legitimacy to a sector that turned a 7-fold increase in the selling price of their product into reduced free cash flow per share. That was an amazing accomplishment.
It's I think I saw a clip of yours where you were not as kind to those people that managed to lose money in a rising gold price. But this basically makes me think that you don't necessarily buy the argument that says gold miners are way undervalued relative to the gold price.
The industry is chronically overcapitalized. Investors have been far too kind to the industry. I mean, we talked about the majors. Just for fun, let's make some real enemies among the issuers. And I've done this on your show before, you may not remember, but I remember it well because I got a lot of hate mail for it. If you merge every junior in the world, all the Canadian penny dreadfuls, the Americans, the AIM, the Aussies, there's probably 3,000 of them now, into one company, we're going to call that Junior Explorco. Okay, we've merged every public junior in the world into one company. In a very good year, that company would only lose $2 billion. In a bad year, not bad for them, it meant they could raise money. But in a bad year, they'd lose $10 billion. So you have an industry, the junior mining industry, that loses somewhere between $2 billion and $10 billion a year. You guys are young, smart guys. How much would you pay for a company that loses $2 billion a year? Would you pay 5 times losses? 8 times losses? In a bull market, maybe you'd pay 15 times losses. The industry is chronically overcapitalized, and it's the investor's fault. If we are dumb enough to send checks to people who pay themselves well while losing you money, It isn't their fault that they take our money. We need to be more discriminating. And I think I understand this. I think if you look back to the decade of the 70s, that is when today's investors, when the industry's investment perspectives were formed. The gold price went from $35 an ounce to $850 an ounce. And at the beginning of the decade, that is to say 1970 through 1975, the management teams had been through 30 years of a bear market. They were extremely efficient. They didn't waste the first 5 years of that decade. The consequence is that people came to associate a rising gold price with the success of gold miners. And they looked for gold mining companies that could exhibit leverage to the gold price. Now, this is an ironic request in retrospect, because the most leveraged gold producers are, of course, the most marginal producers. Somebody who has a fairly high cost structure enjoys more margin increase when the gold price rises than a more efficient producer. So over 50 or 60 years, investors have asked the gold mining industry to exhibit as a primary characteristic leverage to the gold price. In other words, we've asked the industry to become marginal, and the industry has complied. The consequence of that, of course, is the decade 2000 to 2010, where, as I keep repeating, the selling price of the product went up sevenfold and the free cash flow per share declined. Or in the sector that you and I are all talking about now, you all and I are talking about now, the juniors, you have 3,000 public companies that, if merged, would lose somewhere between $2 and $10 billion a year. I understand the narrative around the sector. The reality around the sector is, if you don't do securities analysis, if you don't throw most of the companies in the sector out of your sphere of consideration, you will lose money.
And while screening those companies, I mean, every day there are hundreds of companies coming out with news between the 3 or 4 major exchanges in the world. In what way do you evaluate all those news releases? Are you screening headlines? Do you just follow the 10 or 20 companies that interest you? Because this show is about partly about screening mining movers of the week and the reasons why they go up or down. What's the way that, how do you apply that on a daily basis?
I do several things. You may know, Antonio certainly knows, that anybody who wants to submit their portfolio to me will get it back ranked for free. The consequence of that is that I spend something like $350,000 a year on screening and securities analysis. I don't do all that myself. I don't pay myself $1,000 a day to do this. There is a group of people who work for me full-time and part-time who are competent in geology, competent in finance, competent at reading proxy statements and management information circulars, and we do our best. Having said that, we only attempt to follow 760 companies today out of a universe that exceeds 3,000 companies. We certainly, I included, screen online for news. But I don't react to news so much as use the news around data points. A very good drill hole, as an example, is not a piece of data that I take in isolation. I look at the drill hole and I try and apply the drill hole on the company's own website, if I can, to the geological information that they've presented, and try to understand how the drill hole changes the picture of the geology. For better or for worse. Can I put that drill hole in context? Can I use the information provided by that drill hole relative to the geological information already presented by the company to get some better sense, either bigger or more certain sense around the probable net present value of the deposit going forward? Does the drill hole answer an unanswered question? Does the drill hole propose a new question? If it's a new question, is the answer to that more valuable than the old question? It's very important that you take these things in context. Somebody will look at a drill hole, let's say, 15 grams over 12 or 15 meters. If they haven't taken that drill hole and plotted it against a cross section, they don't take it in context. Was the width that was reported true width, or did they drill right down the throat of the deposit? You follow what I'm saying? Mm-hmm. It is important not merely to screen for information. It's much more important to apply the information to analyze the deposit. It's much more important to use that information as data rather than as an excuse to act emotionally with regards to buying or selling stock.
What's the minimum amount of time you would need after seeing a news release, recognizing that something potentially significant has happened to a company? Would you never be on the bid at the open? Or would you, if you are really interested, contact the company and meet them?
Oh no, I have on occasion. I remember very well, many years ago, maybe my favorite day of my life. I remember being fairly familiar with a then very small company called Barrick Gold, or American Barrick in those days, and a much smaller royalty company called Franco-Nevada. And I was intrigued about the broad spread oxidized mineralization in the Carlin Trend. Everybody knew it came from somewhere, so everybody was looking for the roots of these feeders. And I remember the news coming across the news wires, and the news wires were dreadfully slow in those days, that Barrick had drilled a hole appropriately called the Screamer. And it was 300 meters of 30-gram gold, 1,000 feet of 1 ounce gold. And I saw it, I read it again. I probably used some colorful language, I'm not sure. I didn't call my US trading desk, I called my Canadian desk, the clearing desk, and I said, buy, just buy. How much would you like? Just buy. What about price? What's the upside limit? You're not getting me, okay? We have $8 million in free credit. Use it. Use it. Just go. Now, that happens very seldom, but if you have a geological model in place and you have a drill hole that exceeds every possible explanation that you have for it, if you understand something about the potential geometry of the deposit, and I knew a bit about the faulting, I knew a bit, or at least I had some ideas about the mineralized emplacement. Now, it's important to note that that's happened once in 50 years of my life. There have been other circumstances, Arequipa being a really good example, where before the drill hole, I owned 9% of the company. I knew the people involved in the company, and I had followed what became the discovery very, very, very closely. I had absolutely no idea that that drill hole would be so spectacular. I had anticipated that Perina was a 500,000 or 600,000 ounce perched scab, a high quality scab, and one that would be a good mine because it was on surface and you could use gravity to push the material down as opposed to lift it out of a hole in the ground. I mean, I had reasonable expectations, but the idea that it was 8 million ounces as opposed to 600,000 ounces was a complete and total surprise for me. So I was fairly aggressive there. The one other time, well, I guess there have been 4 or 5 other times, but the one other time where I bought fairly indiscriminately was Francisco Gold with the Ulsa Sal discovery hole. Again, I'd been on the deposit. I had seen the 2 dimensions on the top of the mesa, but importantly, you could see mineralization going down the cliff former. So, I sort of believe that I could see the third dimension going down the cliff. And I remember too, real discontinuity in terms of grade on top. You'd have some very high grade stuff. Then you had, lower grade and stuff like that. And I remember the drill hole came back, and it was absolutely a stunning drill hole. And I actually was afraid it was a lie. I mean, I figured what they probably did is drilled right down a structure. I didn't believe it was a lie, but I thought it was out of context. And I had the extraordinary good fortune of having Brent Cook working for me in those days, who was a very good geologist. And he hadn't seen the drill hole. I brought him into my office. I said, "What's the explanation for this?" And he said, "I don't know. Let me go do some work." And about 45 minutes later, he called me and says, "I've got it. I've got it. You and I were thinking this was a low angle fault and they somehow drilled down the fault, but that's not true. The analog to this is Batopilas, 15 miles away down in the valley. And that's a supergene. There has been re-enrichment that's occurred as a band. And the model that we had, low angle faults with mineralization distributed along a fault by fluid flows, is wrong. What we have here is remobilized gold. And when then I understood the drill hole in context, and I had a high degree of certainty that nobody else had done as much work as we had. In other words, that this was knowledge that was true, that was proprietary. We were able to be fairly aggressive. No, we were able to be really aggressive in that stock.
Yeah, I just looked it up. I think one of the holes was 260 meters of 5.7 grams. So
that was a
yeah,
subsequent hole. That wasn't the first.
Right.
That wasn't the first. No, I remember that one, just saying, okay, well, nobody's going to have to interpret this one too well. Now, that wasn't true width. It's important to know that. It wasn't drilled down a structure. But in fact, we were able to understand that the supergene was sort of a pancake, and that wasn't a true width. But the true width would have been, at that point in time in the deposit, a quarter of that, which, if it's a deposit that you're going to mine on an open pit basis, is pretty attractive.
Yeah. Right, Rick. Well, it's been as always, kind of funny that you said that one of your favorite days there was a day in which you were looking at stocks. I hope your wife's not going to listen to this and relate to your guys' wedding there. But it's no, it's been as always, it's been a great pleasure talking to you. I know you have to run in 2 minutes, and I also know that you're going to be doing your conference for the 98th time in Boca Raton this year. So give me the pitch.
Sure. I think that the best natural resource investment conference on the planet is mine. I think it's in its 30th rather than its 90th year, although you couldn't tell that by looking at me, of course. July 7th through 11th in Boca Raton, Florida. You can attend live, which is what I would prefer, or you can attend online if you aren't able to go to Boca Raton. Why go? Well, in the first instance, big picture paradigm, the Jim Rickards of the world, the Daniela DiMartino Booths of the world, the Grant Williams of the world, people who tell you about the way the world really is, as opposed to the way that the, CNBC or ABC or CBC wish it were. Once we've accomplished that, talking about the way the world is, we have great analysts and portfolio managers in natural resources, which will tell you how to turn that worldview into money. Important to note, not hack investment bankers that failed at technology, failed at marijuana, failed at consumer lending or something like that, but rather people who are battle-tested in natural resources through thick and thin for 30 or 40 years. And then, of course, we have the living legends. We'll have people who have built multi-billion-dollar mining companies from scratch, telling you about how they did it and telling you how the lessons that they learned made them better investors and make you a better investor. By the way, following them around the exhibit floor, seeing what booths Robert Friedland stops at, or Bob Quartermain stops at, or Ross Beatty stops at, or Sean Rosen stops at. Very instructive. Worth the cost of admission all by itself. Exhibitors at my conference are content too. At most conferences, the exhibitors are simply advertisers. The qualification to be an exhibitor is a check that cashes, nothing more. At my conference, you have to be owned in accounts owned and managed by me. No guarantee that because I own a stock, it goes up, but there is a guarantee that I've vetted them. Whether you attend live or in person, you will have access to the conference tapes, and you'll need it because we're going to work you very, very hard for 4 days. We're going to deliver you more content than you can absorb in 4 days. If, having attended the conference live or live stream, you don't think for any reason that you didn't get your money's worth, email me. Gold plate. You'll get your money back. The financial risk is all mine. No other conference in the world that I know of has a money-back guarantee. No other conference in the world that I know of has the exhibitors vetted. July 7th through 11th, Boca Raton, Florida. Come in person if you can. If you can't, watch it in the comfort and convenience of your own home. Full money-back guarantee.